Yes guys, so let's discuss about AS 15. AS 15 talks about accounting for employee benefits. It's a practically very elaborate standard which we'll try to discuss in brief only to the extent what is applicable for us. Because you'll understand that there are few parts of the standard which are still there in the standard, but when you talk about such things can be understood only when you are practically applying it. Or to put it in such a way that they use the value of an expert or they use the knowledge of an expert or a work of an expert here. So we'll only discuss about that part of the standard which is very, very important as far as your examinations are concerned. Accounting for employee benefits. Now first let's talk about this employee and then we'll talk about the benefit. Who is an employee first? An employee either can be a past or present. Now past employee in the sense he has already left the organization, but still they might be getting some benefits. We normally see that as retirement benefits. So pensions, all these are retirement benefits. Not just pension, they'll have some medical facilities also which are continuing after the employment is over. So it can be either a past employee or the present employees. What is necessary here is an employer-employee relationship. This is very important. To be covered as per AS 15, there should exist an employer-employee relationship between those two people. Now, to explain this employer-employee relationship, the standard comes out with a classical example where they try to differentiate between what is a contract of service and contract for service. They are trying to differentiate between what is a contract of service and what is a contract for service. Now the difference is, whenever you are talking about contract for services, these are nothing but professional services. So when I am talking about their professional services like a chartered accountant, or let's say they have gone for a statutory audit, then chartered accountant is necessary. There's a court case which is pending, they go to a lawyer. Let's say I want to construct a particular building, I go to an architect. Now these are called as professional services. Now whenever there is a contract for service, then such professional services, we say that there is no employer-employee relationship. There is no employer-employee relationship. The parties enter into a transaction on a principal to principal basis. Now what is the difference between a principal agent, principal to principal, and what is an employer-employee? Now principal to principal basis, whenever you're talking about a professional service, when I give an audit, let's say I've employed XYZ and company as a chartered accountant for a particular statutory audit. What happens? I am not going to tell him how to conduct the audit. Now he has his own particular agenda, how he's going to plan for the audit. Same way, I don't go to a doctor and start saying that, you need to conduct the operation this way. You need to first cut this, use this knife. I'm not going to use all that. I'll just say that, I have a particular problem. You have to treat this problem. Now, what is the medication that he gives? What is the operation that he has to do? That I and you can't decide. Same thing happens with an architect. I can only tell him that probably I want a piece of, I have a piece of land and on this I want this particular building and this much SFT is what is required. Now, how the architect plans his entire activity is based on his intelligence, his skill. Now, they are called as professional services. In such professional services, there is no employer-employee relationship itself. But if such professional is actually employed by the organization, then there will exist an employer-employee relationship. So there could be a chartered accountant who is hired or who is under the employment, under the payroll of that particular company, taking some position of a CFO or an assistant CFO, whatever it is. They will come under the definition of the employer-employee relationship. But these professional services, contract for services, you cannot call them as employer-employee relationship. but contract of service. Whenever I am discussing about contract of service, they are non-professional services. They are called as contract employees. Let's say we have a driver. Okay, a driver is employed. He is not under payroll. I've just given him some particular agency a contract to provide me driver or housekeeping person every month. So I'm paying it to the agent, and that agent is supplying a particular human resource to me. Now you tell me, the driver will not decide where to go, right? And definitely he is under your own instruction. Housekeeping services, I am instructing them how to conduct that service. When I instruct them how to use the service, then I will definitely say that there is an employer-employee relationship existing. Employer-employee relationship exists when it is a contract of service. Though they might not be on your payrolls, but still I'll include them as an employee as per AS 15. This is what we discuss about who is an employee who is covered under the standard AS 15. Now what are the benefits which are covered under AS 15? The benefits when I am talking about, there could be some monetary benefits or non-monetary benefits. Monetary or non-monetary benefits. What is a monetary benefit? What is a non-monetary benefit? Monetary benefits are nothing but allowances. Non-monetary are perquisites. Now, all allowances and perquisites are basically covered as a part of employee benefits. Now, whenever you're talking about a benefit, such a benefit, let's say I am providing a benefit not just to the employee but also to his spouse and children. Let's say I have a particular school and I am giving employment, all my employees, the children will be, availing the education facilities in my school. So what is happening? I am not directly giving it to the employee. I am directly giving it to the children of the employee who are enjoying it. Or a scholarship plan is given to the employee's children. So some scholarship the company has announced, and such scholarship also is a benefit which is given. Will they cover them under employee benefits? Yes. So whenever you talk about the word benefit, such employee benefits can either be given to, they can be enjoyed by the employee himself. Directly I am providing it to the employee, or I can give it to his spouse or children, or I can also give them to other dependents. Mom, dad, your brothers, sisters, all those will also come under other dependents. Normally with every standard we touch the applicability as well, but here in this particular standard I'll park the applicability towards the last. The particular reason why I'm parking it towards the last, because we'll understand the applicability only after we complete the entire standard. So we are not discussing about the applicability now. I'll take it up towards the end of the standard. Now, when we're talking about accounting for employee benefits, that means I have to talk about recognition and measurement, because the name is starting with the word accounting. What am I accounting for? Employee benefits. So these employee benefits, whatever are enjoyed, have to be first identified as what are the employment benefits given. The standard classifies the entire employee benefits into 4 categories. The first one is called as short-term benefits. Retirement benefits. Normally retirement benefits are also called as post-employment benefits. Other long-term benefits. And finally, termination benefit. Termination means at the time of removal what they get. LT stands for long term. Other long term benefits and termination benefits. Now, what is the short term benefits? Short term benefits are anything which are allowed to employees within 12 months period. Within 12 months, whatever benefit is given to the employee, I'll call it as a short term benefit. Now, within 12 months, what does an employee get? Employee gets salary, employee gets some allowances, employee is allowing some perquisites like use of car, use of a furnished house or an unfurnished house, whatever it is, it'll come under the short term benefits. Now, along with that, they also get bonus. At the end of the year, each year, normally the employees are entitled to bonus as per Payment of Bonus Act. Now, that will also be covered under the short term benefit. Along with that, they are sometimes also paid as a commission also. Such commission will also come under the head of short term benefits. So when I'm discussing about short term benefits, it could be salaries, periodic allowances, bonus, profit sharing or commission. All these will be covered under the head of short-term benefits. Let's come to retirement benefits then. Post-employment benefits. Post-employment benefits, what they get is pension, gratuity, superannuation, medical, and plenty more. After employment or on employment, on the completion of employment, whatever they get, they are called as retirement benefits. Other long-term benefits mean, in the sense, they are not at the time of retirement, but if you are within the organization for a particular period of time, you will be entitled to receive this. They are called as sabbaticals. It's a long-term leave that they get, guys. Sabbatical, normally people go for an MBA after their 4 years or 5 years of their employment. That is called as actually sabbatical. Disability allowances or disability benefits. All these can be covered under other long-term benefits. Termination benefits, at the time of removing them from the organization, what do they get? VRS, Voluntary Retirement Scheme, very popular scheme in late 2000s. And we also have retrenchment compensation. Retrenchment compensation paid under Industrial Disputes Act. This is in brief what each benefit is talking about. So there are short-term benefits, retirement benefits, other long-term benefits and termination benefits. And what we say is we need to identify recognition and measurement. Recognition and measurement for each such benefit. Now what we'll try to do is these two benefits, which are other long-term benefits and retirement benefits, the recognition and measurement is same. Here I don't have a separate recognition and measurement, but I have a separate recognition and measurement for short-term benefits and termination benefits along with these two. So how many recognition and measurements that we have to see? 3. 1, short-term benefits. Second one, for retirement benefits, that is post-employment benefits as well as other long-term benefits. Third one is termination benefits. Now we'll have to discuss about each and every part here. First, let's see the short-term benefits. How do we account for the short-term benefits? Now, short-term benefits, I don't have to account for separately. If I solve an accrual basis, normally the short-term benefits are automatically accounted. So, always remember short-term benefits are accounted on an accrual basis, whether it is paid or not. If my benefits paid are less than benefits allowed to the employees, I paid less, then it becomes a liability for me. These liabilities popularly are called as outstanding liability or outstanding salaries, outstanding allowances. And if you have the other way around, let's say my benefits paid are more, then it becomes a asset. Such assets are called as prepaid salary or advanced salaries. While we are talking about short-term benefits, I said it is less than 12 months. So whenever you are talking about less than 12 months, always accounted on undiscounted basis. Discounting comes into picture only when the benefit extends for more than one accounting period. It is within the same accounting period, so I don't have to discount at all. So no discounting for these benefits. Now, the problem will pick in for recognition and measurement of short-term benefits when we are discussing about short-term compensated absences. What are these short-term compensated absences? In a sense, for a leave, you still pay salary. Normally what happens in any company, they normally allow 15 days or 20 days in a year as casual leaves. The employee can use those casual leaves at any point of time. Now in the same way, they are also giving some medical leaves as well. Now during the time of this leave also, the employee is entitled to get salary. Now they are called as compensated absences. That means I am not reducing the salary for his absence. I am compensating him with the salary even during the period of absence. Now this is what we have to discuss about. Whenever we are discussing about short-term compensated absences, we'll have to identify that there are two types of absences. One is called as accumulating absences. Other one is non-accumulating absence. What is accumulating absence? That means if I do not avail the leave in the current financial year, then I can carry forward the leave whatever is unutilized for the subsequent years. So let's say I am allowed 15 days of a leave this year. I have used only 5 days. So that 10 days of unutilized leave can be carried forward to the subsequent financial year. They are called as accumulating. That means it keeps on coming to you. So they are called as accumulating compensated absences. Non-accumulating, you did not use, you cannot use. So, first year I have given you 15 days of leave. I availed only 5 days. 10 days will not be carried forward. Next year, again the maximum leaves allowed are only again 15. So, whatever is unutilized, I am not carrying forward to subsequent financial years. So, whenever you are not carrying forward, I don't need a separate recognition at all. Here, no separate recognition. But when we are talking about accumulating compensated absences, compulsory there should be a recognition that should appear. So when we are talking about this accumulating compensated absences, I'll split them into two types. These accumulating compensation absences accumulating short-term compensated absences can be vesting or non-vesting. What is this vesting accumulating short-term compensated absences? Vesting benefits in the sense they can be encashed. Encashable leaves. Non-accumulating, I cannot encash. But I am eligible to use. That means I have to compulsory use the leave. I cannot encash the leave. So 10 days of unutilized leave is there. At the end, whatever is 10 days salary, he'll get it back. That is one way. They are called as vesting compensated absences. Vesting accumulating short-term compensated absences. Non-vesting benefits. Non-vesting in the sense you cannot encash, such leave should be compulsory used. Now, the problem actually does not happen with this vesting benefits. The problem appears with the non-vesting benefit. Now, why does this arise? Now, let's say I have about 300 days of working days because I have removed those working days or Sundays. I have removed 52 or 53 Sundays are there that you remove. So, about 6 days a week on an average, let's say 300 working days. Let's say for suppose I have allowed 15 days of leave to each employee. Year 1. Or 300 days of working days, 15 days I am saying that you can take a leave. So 285 days is the actual working days. So when I am paying salary, the salary is only paid for this. When I pay salary, it is paid for this 285 working days. But I pay for the entire year, but what the benefit is received by the company is only for this 285 days. So when I am talking about a company, every expenditure has a benefit. So such expenditure benefit, rent is paid. What is the benefit that you are getting? You are getting to use the premises. Same way, salary is paid. What are you getting in benefit? In return, I am getting the employee services. And how many days of employee service am I getting? 285 days. So, 12 months of a salary if I pay, I am entitled to use an employee services for about 285 days is my logic which I get into my head. Let's put this as year 0, let's say. Let's take some random figures now. Year 1, let's say, out of 300, this fellow allowed a leave only for, I will leave only for 5 days. He worked for 295 days. Year 2. Now he used 10 days. 290. Year 3. Here, I have accumulated leave of 10 days, I have accumulated leave of 5 days, total 15 plus current year 15. So total 30 days I utilized and I worked only for, and this person worked only for 270 days, let's say. Now these are accumulated leaves. I am accumulating these leaves and finally I got the entire 30 days. Now, for suppose, imagine. A salary is paid, I am getting a benefit for 285 days. But now check, first year, how many days did I utilize the service of the employee? 295. 295 in the sense, I am using 10 days of an extra service. Now for that extra service, did I pay extra? No. But, this 10 days, when he is using it here, I paid a salary for entire 12 months for which I am eligible to get 285 days of working days. But how many working days did I get? 270. That means I am losing my employee services for about 15 days extra. Now that 15 days I am paying an extra cost here. Because when I paid the salary, I paid according to 285 days of working, but I received only 270 days of working. That means I am losing 15 days because I have actually gained the 10 days here. Now this 10 days, whatever extra days that he has actually utilized, I have to create a provision so that such provision can be compensated here. Use your matching concept. What does the matching concept say? 285 days of a salary should be debited. But how much am I how much did I use? 295 days I used. 285 days normal salary you paid, 10 days extra, he is eligible to get extra expense. Because extra benefit I used. Extra benefit, extra expenditure. This extra expenditure of 10 has to be booked in year 1 itself. Extra expenditure in year 2 is 5. How many days extra? 15 days extra expenditure is already booked. Now here what happens? When I'm paying salary, I paid 285 days of salary, 15 days of provision is already existing. So how much will be debited to P&L? I will debit only 270 days salary to P&L. Balance 15 days I have already got it from a provision which is created in year 1 and year 2. So what is happening? When we try to put it across, year 1, debit to this P&L. My salary debit is 285 and the 10 days extra whatever he got, I'll write it as a provision. Similarly, even year 2 as well. My salary debited to P&L is only 45 days. The 5 days extra I worked, I'll create a provision. Now this provision will be appearing in the liability side of balance sheet. The total provision, first year 10 days, second year 5 days, total 15 days of provision is there. When we use in the third year, my salary debit will only be for 270 days and I'll utilize the provision here for 15 days. Or I'll write it like this. 285 days salary which I paid, I'm using the provision, so minus provision utilized 15 days. So how much is debited to P&L? Only 270 days is debited to P&L. Here debited to P&L is 295. That is a benefit that I got from utilizing the service of an employee. Second year 290. Third year only 270. That is a benefit utilized for an employee and this is how you do it. Now, what did we arrive at? We have arrived at a concept saying that 10 days of extra working days, whatever this fellow has utilized, then I have to create a provision for 10. Very good. But when you create a provision, you need to know what is the value for which you create a provision. When is this fellow using this 10 days salary? Somewhere in future. Here I am saying third year he used. But he can use it in year 4, year 5, year 6, whichever year he wants. On what basis should I create a provision? When he utilized the pay, when he utilized these extra days, I am utilizing in year 3. So what is the salary that fellow is getting in year 3 is not the same what he used to get in year 1. Because there's an increment in salary every year. Then how will I charge a provision? Because standing in year 1 ending, I know 10 days this fellow can use. Now when will he use? Let's say I have estimated that on a reasonable basis, year 5 he'll use. Year 5 salary you know. I don't know. I know year 1 salary, that's it. Year 2 salary at the max I know because I have already given him some increment of about 10% or 12%. Year 2 fine. Year 3 reasonably estimated. Year 5? Year 7? Year 10? How will you estimate? How long can you estimate? Now this is the main problem what happens. Because I exactly don't know which year this fellow will be availing the leave and what will be his salary when the leave is availed. So two things are very important in the creating the provision. Number of days, which I know. I have to multiply it with the salary when the leave is availed. When the leave is expected to be availed. This I don't know. I don't know which year. I don't know what will be his salary in that year. Both I don't know. So I only know this figure. I only know the number of days as 10 and 5. I do not know what will be his salary that is expected when the leave is being availed. Now this is what we don't know. How do I expect this? So this, what we'll leave it is we'll give it as a management estimate. This is a perfect management estimate, guys. The management will come out with an estimate saying that there's a probability of these employees availing the leave in the year 3 or year 4. And in year 4, current salary is 100. Then I am expecting that year 4, every year there will be an increment of at least 10 to 15%. So on that basis, I am estimating, I am creating a provision on an estimated basis, expecting his salary in the year in which he is availing the leave. As such, I leave it as a management estimate. Practically what they do is, they normally take whatever is the current salary only, and every year they keep revising the estimate. So current year I'll provide a provision on 100 rupees basis. Next year if his salary is 115, then I will revise the estimate for 115 rupees. So every year they keep changing. But otherwise, if you go by the standard, it should be an estimate based on the expected year in which he is going to avail the leave and what will be his salary when he has actually availed the leave. Both conditions should be considered. Now when you're coming to vesting encashable leaves, encashable leave normally is encashment portion is always basic. A basic or basic plus DA is actually your encashable portion in a genuine salary basis. So encashment, whenever you are considering, you need to consider a provision only to the extent it is encashable. So, but when you're talking about non-vesting leaves, during that non-vesting period, I can't say that, when he is using this 270, I can't say that, you are not supposed to live in this, the furniture which I have given, you can't use it for that 15 days. The car which I have given, you can't use it for this extra 15 days. I can't do all this. So basically those allowances and perquisites I will pay throughout. So when you're creating a provision for non-vesting benefits which are not encashable but they have to be availed, then your provision should be created on the basis of his total salary. Salary including his allowances, perquisites, everything you have to put in creating a provision when you're talking about non-vesting. But when you're talking about vesting, only to the extent of encashable portion, I'll create a provision. My estimate basis, my valuation basis will only be towards the encashable portion here on the basis of total salary. So I'm saying when you're measuring the provision, vesting only the encashable component. Of salary, but non-vesting where I will use the leave in the future, I'll create it on the basis of total estimated salary. In the year in which the employee is expected to avail the leave. Now that will bring us to the end of the topic for short-term benefits. Now we'll have to discuss about retirement and long-term benefits put together. Because I said the recognition and measurement for both retirement and other long-term benefits is actually the same. So let's discuss about that. Post-employment benefits. also will include other long-term benefits. These two benefits, we will actually try to classify these benefits into two types. Defined benefit plan defined contribution plan. Now what is this defined benefit and defined contribution? Defined benefit plan means the benefits arising to the employee are defined. He knows how much he will get on at the end of his employment. Like you can take the case of gratuity. How does he get gratuity? Gratuity, let's say, if it is to be calculated, 15 days of salary for every completed year of service multiplied by his last drawn salary. Now I know that I will get 15 days salary, but the benefit what he is getting is defined. How about the contribution by the employee? The employer has to contribute towards the plan because I have to pay him at the end of his employment. So when I'm paying gratuity at the end of employment, observe the gratuity liability increases every year. With every completed year of service, the gratuity provision keeps on increasing. This figure increases, gratuity provision automatically increases. So if this increases every year completed services, then your gratuity also increases. So that means every year he is completing his service in my organization, my liability to pay gratuity to him will be increasing. So every year it raises to my, it is increasing my gratuity provision. So I'll have to make a provision every year towards the gratuity of every employee. So let's say I am employing a particular person at the age of 25. Let's say retirement age is 30. Or let's say retirement age is 60. So how many years I have to create the provision? Every year I'll have to create a provision for the next 35 years. How much? Year 1 how much provision? Year 2 how much provision? Year 3 how much provision? Year 4 how much provision? You don't know. Because the amount that will be identified is only after 35 years, 15 days into 35 years into, I don't know, into last drawn salary. At the end of 60 years, when he becomes 60, what will be his salary? I don't even know. Now on what basis will I estimate that? Now that is why we call it as defined benefit plan. What is received by the employee is a defined benefit, or that is compulsory, a concrete figure. But what is to be contributed by the employer, you don't know. What is the amount of provision to be created every year is not certain. But I will have to create a provision which I know. Because with every completed year of service, there is a gratuity provision which is keep on increasing. So every year I have to make a provision, but I am not certain about what is the amount of provision to be maintained. This is very simple. Defined contribution. The contribution of employer towards the plan is defined. How much the employer contributes towards the plan is a set figure, is a concrete figure. That is what we call in defined contribution plan. So how much will he be giving, then that will be created as a provision. For example, take provident fund. Or take superannuation. whatever it is, my contribution towards the PF is up to a maximum of 12% of his salary. Well and good. I know what is his salary. I know how much I am contributing every year. So whatever is contributed every year, that will be created as a provision. As simple as that. So, yearly contribution should be recognized as expense in P&L. That's it. Over. There's nothing great when you're talking about defined contribution because you know the figure. When you know the amount, then directly take it as an expense in your P&L and clear the matter. But can I write similarly for this defined benefit? I can't because I don't know what is the amount of provision. I'm not paying anything today. So the payment obligation is arising only at the time of retirement. Now at the time of retirement, how much I'll have to give, I don't know today. And I have to create a provision for that. And this is the reason why this defined benefit plan becomes very important. Now, when we discuss about a defined benefit plan, you need to know how the employer actually deals with the defined benefit plan. Now, obviously, at once to pay the entire amount of gratuity, any organization will face difficulty. Let's say on an year basis, every year 10 employees are leaving the organization on retirement. So 10 employees into every completed year of service, how many years? 15 days of pay into the salary last drawn. Someone who's at a retirement age obviously will be drawing good salary. Now, how will I make sure that so much cash is available towards that? That means every year I have to make sure that this cash is being available. So, to provide this cash available, the employer normally tends to go for various plans. Like one thing is called as insured benefits plan. In the sense, I will take an insurance policy. Yearly I'll be paying premium. For each employee, I'll be taking an insurance premium. I'll take the premium policy and I'll be paying the amount of premium. Now, at the end of the retirement age, the insurance company will pay the amount of benefit to him. How much are they paying? That they will decide at the end, no. But my contribution towards the insurance scheme will be a fixed amount. So what happened? Though it is a defined benefit plan, I am converting into a defined contribution plan now. Because who is doing the variable benefits? Who will pay? Insurance company will pay. What is the employer paying? Premium. Premium amount I know. It becomes a defined contribution plan. This is one way to tackle the benefit. There is one way to tackle the issue of defined benefit plan. Some people what they do is, they do multi-employer plan. Multi-employer plan in the sense, all the employers put together, they'll come together and form a particular group. And this group will start taking whatever is the provision. Let's say this company X has maintained a provision of 50,000 rupees. Y has maintained a provision of 80,000 rupees. Z has maintained a provision of 1 lakh rupees. All these provisions put together, I will pool the cash and I'll give it to a small trust. This trust is called as multi-employer trust. So all these employees are donating the cash or contributing the cash towards the trust, and this trust will be headed by a particular person who is there into wealth management services. So they will try to make sure that the investments are planned in such a way that they will give me sufficient returns, and at the same time sufficient cash is made available at the end of each year for payment of your benefits. Got it? So this is one way of tackling it. Like this, we have plenty of schemes how we can tackle the issue of defined benefit plan. But as such, when you're talking about a defined benefit plan, we need to understand that every time you create a provision, there is a liability which is coming up. At the same time, such amount of provision maintained should be deposited or should be invested in the form of an asset. Such investment should be matured and the amount of benefit will be paid to the employee here. Now, so what is happening? By maintaining a provision, I am creating two things. One, liability, other one in the form of an investment which becomes an asset. If you remember this logic, you can link it with sinking fund. What happens in a sinking fund? We normally say that depreciation provides cash sufficient to replace the asset. Very good. Let's say I have an asset which has a life of 5 years. Every year I started depreciating. You and I know that basically that depreciation is a non-cash expense in the P&L. Non-cash expense in the sense I am not paying anything, But such amount got debited to the P&L. So that is anyways cash. So this cash will be pooled aside. Every year if you keep pooling aside, at the end of 5th year, obviously you will get cash. And such cash is sufficient enough to replace the asset, he'll say. Now understand guys, that is only theoretical concept. Let's say 100 rupees was the asset. At the end of 5 years, how much you will get? 100 only. Because depreciation cannot exceed the cost. So 100 rupees I am basically getting over 100 over the 5 years period. Now same 100 rupees, if I go to the same seller and say I want the same asset for 100 rupees, will he give? Not possible. Because over 5 years period, there is something called as inflation which strikes you. So that 100 rupee asset today will become actually 130 or 140. Now, did the depreciation provide sufficient cash for replacement of the asset? No. Because you are still falling short by 30 or 40 rupees. That is the reason why the concept of sinking fund came into picture. Now what does the sinking fund do? That 20 rupees, 20 rupees, 20 rupees, whatever you have put it as depreciation, every year, year 1, I will deposit that 20 rupees into some investment. Some investment I will take at the end of year 1 with that 20 rupees. Second year, again I got 20. So in the second year, that 20 rupees will be again invested. Third year, again I invest. Fourth year, again I invest. Fifth year, no investment because I need cash. So whatever has been invested, I will try to sell all the investments at the end of 5th year and I'll take cash. But if you understand, what you have invested in the year 1 for 4 years is getting you return. What you have invested in the second year is giving you a return for 3 years. What you have invested in second year will be giving you an interest for 1 year. Like this, if you put across, what you have invested is though 100 rupees, I will not have 100 rupees at the end of year 5. I will have 100 plus the amount of interest. Now, whatever value of investments you purchase, that can also be sold at a profit. Now that profit also gets accumulated. Now so much of cash will be available for replacement of the asset. That is the concept of sinking fund. Now the same sinking fund concept we are adopting here. When you have to pay benefit at the end of that fellow's retirement. Now how much is the amount of benefit paid? I don't know. Same thing. Asset I have to buy at the end of 5 years. How much you have to pay for buying the asset? That I don't know. So what are we trying to do? We are creating a provision and such amount of provision will be invested into a particular asset. Now such asset will be sold when you have to pay such benefit. Same way, when you're talking about a defined benefit plan, we'll have two things which will be arising. One is called as a planned liability. Other one is called as a planned asset. What is a liability here? That planned liability is provision for employee benefits. Such provision that you maintain should be invested will be called as a planned asset. Now, earlier under defined contribution plan I said, whatever is your yearly contribution, you charge it to P&L. Here, how do I charge to P&L? Now, when he talks about this scheme, he'll say that my charge to P&L under the defined benefit plan is your current service cost interest cost return on plan assets actuarial gain or loss past service cost and the last one is called as curtailment or settlement. Multiple amounts to be transferred to P&L. What is the current service cost? What is an interest cost? Return on plan assets. Whatever you have invested, that investment will be giving you some return. Such return also should be taken. There's some concept we have to see which talks about actuarial gain or loss and past service cost and what are these curtailments and settlements. Now each part of this charge will be very, very important to deal with. Now, when we're talking about actuarial gain or loss, we will talk about some concept called as actuary and actuarial valuations which will come into picture. But as of now, let's talk about what is this current service cost and interest cost. Now let's say, for example, I have a particular employee and this employee is Mr. X. This Mr. X has a current salary of 10,000 rupees per month, let's say. His salary is expected to increase by, let's say, 10% every year. Every year I am expecting his salary to increase by 10%. And the benefit to be paid according to your defined benefit plan is, let's say, 1% of salary. At the end of retirement, for every completed year of service. Or let's say 10% benefit, 10% of salary should be paid at the end of retirement for every completed year of service. Now practically talking about, we have number of years up to service is about 30 years, 35 years also will be there, because someone who is getting employed at 25, if the retirement age is 60, then he has 35 years to go. I can't fit all 35 years into here, so I'll take a very small basis. So let's say number of years to retirement is equal to 5. Only 5 years to retirement. I'm just trying to confine my calculations. Now, if this is the defined benefit plan, how do I create a provision? And from this example, we'll understand what is this current service cost and interest cost. Now, if I'm given this particular case, I will first have to think about what is the benefit? 10% of salary at the end of the retirement for every completed year of service. How many years? 5 years. What is the salary at the end of the retirement? That I don't know. I have to calculate. So, salary on retirement, you can calculate 10,000 into 1 plus 10% power 5. Because 5 years, 5 times his salary increases. So, first year ending, it will be 10,000 rupees plus 10%. So, his salary will become 11. So, next year, again 10%, again increase, again 10%, again increase. Or like that, at the end of 5th year, what should be his salary? Just calculate 1.1 into 1.1 into 1.1 into 1.1, like that 5 times, multiplied by 10,000. Salary is 16,105 at the end of 5th year. Of this, how much is he getting? 10%. So my benefit is equal to 10% of 16,105 multiplied by 5 years. So it will be 1610.5 into 10 into 5. 8052.5, I guess. When is the benefit supposed to be paid? At the end of 5th year. Now, when you know that the benefit is supposed to be paid in the 5th year and the amount to be paid in the 5th year is 8052, what is the amount of current year provision that I have to create? 1/5 of that. Correct? And 1/5 of what? 1052. Now, when you talk about 8052 into 5 into 1 by 5, I know that the benefit is supposed to be paid at the end of year 5. So standing in year 1, I will discount it and I will only give the present value of that 1/5. Correct? So what is the every year provision? Provision each year is equal to 8052.5 into 1 by 5 into the present value factors. Year 1, year 2, year 3, year 4 and year 5. First year, actually 8052 into 1 by 5 is nothing but 1610.5. So 1610.5 multiplied by present value factor. Year 1 you are creating a provision. At the end of year 1 you are creating the provision and the amount is paid at the end of year 5. So how many years discounting should I consider? First year, year 2, year 3, year 4, year 5. 4 years discounting, because from the end of year 1 to the end of year 5 is only 4 years. Multiply by present value factor. Let's say the discount rate, let's say I'm taking some discount rate here as 10%. Ten comma 4. 1610.5 into year 2. I'm creating a provision at the end of year 2 up to year 5. Year 3, year 4, year 5. Only 3 years present value. PVF 10 comma 3. Like that, if you keep on calculating into PVF 10 comma 2 into PVF 10 comma 1. Last year I will create the complete provision 1610.5 because year 0 discount factor is 1. Keep calculating and get the amounts. PVF of 10 comma 4 is equal to nothing but 1 by 1.1 into 4 times. 1 divided by 1.1 to 1 divided by 1.1 divided by 1.1. 4 times you have to multiply. If you are using your calculator, it should be 1 divided by 1.1. 4 is equal to 4 times you press is equal to, you will get the answer. Multiply it by 1610.5, you will get the present value factor of the amount to be created as a provision. You can round off the amount, no problem. Yes guys, so let me take the values. They are the present values guys. Now, whatever you calculated as the present values, these figures are called as current service cost. This is called as current service cost. Then what is the interest? Interest cost is talking about. Interest cost means what I provided in the first year as 1099, in the next year there should be some 10% increase. That is when after 4 years it will become 1610. Correct? Because I am saying today if I provide 1099, that is sufficient enough to get 1610 at the end of 5th year. That means every year the 1099 amount, whatever you invested, it keeps on increasing. That increase every year is by 10%, and such an increase is called as interest cost. I will try to demonstrate this interest cost as well. One, 2, 3, 4, 5 years. Opening provision. Obviously first year is 0 because I am trying to create. How much is the provision that you are creating? That is your current service cost. Your current service cost is an amount provided each year. You know current service cost every year. First year is 1099. Second year is 1209. Third year is 1330. Fourth year is 1464. And final year is 1610. I'm just ignoring the 0.5. What is this interest cost? Interest cost is to be calculated on 10% on opening provision. Every year there will be an interest cost of providing each year. I have provided 1099 first year. Every year it should keep increasing by 10%. That is when at the end of year 5 it should become 1610. So first year there's nothing as an interest cost at all. But come to the second year, I already have an opening provision of 1099. Now on this I need to have an interest cost 10%, 110. I'm rounding it off. So what will be the third year's opening provision? 1099 already existing plus 120 and current service cost plus 110 is your interest cost. All the three combined will become your opening provision. I think this is 2418. %10 of that, 242. Next year, 2418 plus 1330 plus 242 interest cost. 660. 3990. So 399 rupees of interest cost in the fourth year. And fifth year opening provision will be 166,913 or 3990 plus 1464 plus 399. 5853 and the interest will be 585. Now if you want to check at the end of year 5 how much amount you have, 5853 plus 1610 plus 585. the amount available at the end of year 5 should be somewhere close to 8052 again, because that is the amount that we need at the end of 5th year. Since we have been rounding off, you might not get the exact figure of 8052, but in and around 8052 is something that you are expecting to get. How much is the amount? $8048. You did not get exact 8052 guys, because of the rounding off that we have been doing. So otherwise, if you are taking the correct decimals, you will get the exact figure of 8052 again. So this is how we understand what is a current service cost and your interest cost on that. So two charges to P&L over. We have to talk about what is this return on plan assets, actuarial gain or loss, past service cost, and curtailments and settlements. What is this return on plan assets then? We have seen the current service cost and the interest cost. A third one, that is your return on plan assets now. What is a planned asset? Return on plan assets. Plan asset is nothing but the amount invested, that provision whatever you have provided for your employee benefits, that is being invested, and such investment portion is called as plan asset. Every asset, every investment should be fetching some return. Such return we are getting in the form of plan assets. Now whenever you talk about return on plan assets, there could be some interest, or there could be some dividend which is earned, or there could be some gain on sale of investments also. Everything is called as return on plan assets. Under return on plan assets, we will have to discuss about two things. Expected return actual return. What is an expected return? I am expecting that my investment should fetch about 15% on an average. That is an expected return. Actual, how much did I actually get? So when we are talking about expected return, so expected return as a percentage multiplied by the amount of plan assets. Whatever is the value of plan assets given as a percentage will be your expected return on plan assets. This expected return on plan assets should be always credited to P&L. I don't take actual return into P&L. What I take to P&L is your expected return. Return, income. Income should be credited to P&L. But there is another called actual return which I will not consider in P&L. But I'll still have to calculate. I'll tell you where I use the actual return. Actual return is nothing but fair value of plan assets closing is equal to fair value of plan assets opening plus contribution towards plan minus benefits paid out of the plan plus actual return on plan asset. Now using this particular formula, you can identify what is the actual return on plan assets. Because my actual return on plan assets is equal to fair value of plan asset closing minus fair value of plan asset opening minus contribution plus benefits. But this is easier way of understanding this formula. Now what are we trying to do? Think as if this is a capital. Okay. A capital invested in a business. If I'm asking you to draw a balance sheet, in the balance sheet on the liability side, when you put the heading as capital, what are the adjustments you do? Opening capital plus additional capital introduced minus drawings plus net profit. Now try to fit in. Opening capital, contribution towards the plan means extra capital invested minus benefits paid out of the plan. Whatever you are paying, whatever is your drawings out of it, plus net profit, you are talking about actual return. The same formula, just put in a different way. So what are we saying? We are saying that whatever is the value of plan assets at the beginning of the year will get added up by whatever I am contributing towards the plan. What is your contribution towards the plan? We have already seen. This is the amount of provision maintained every year. This amount of provision should keep on investing. So whatever is the contribution I can calculate. Minus benefits paid. Some employee is retiring, I have to make the payment of the benefit. Now how will I pay benefit? Out of the plan assets. Otherwise I wouldn't have maintained the plan assets. My maintenance of plan assets is to make sure I have sufficient funds at the time of paying those benefits. So benefits paid will be reducing the value of plan assets. But don't forget, it will also reduce my liability. When one employee is leaving the organization, what happens to the liability? My liability of benefits to be paid is also decreasing. So I'm reducing out of the plan assets as well, plus whatever actual return that they make out of the plan assets. Got it? So this is the actual return. But I will not take this to P&L. What I'm transferring to P&L is only the expected return. I will use the actual return somewhere else. I will not touch the concept of actual return when we're talking about P&L at all. Now we have to touch the concept of actuarial gain or loss, where we talk about actuaries and what valuations they do and how we adopt those valuations into our AS 15.